Shares of data specialist Snowflake are down almost 20% this morning. So, what is going on with the company, and should investors be worried? My name is Brian Stoffel, and at the time of this recording, I own shares of Snowflake. We'll talk about what's going on with the company, why I'm not worried, and the two big reasons why the stock is down big today over the next 10 minutes. Thanks to YCharts for sponsoring today's video. Let's dig into the company's earnings. This was their first quarter of fiscal 2024 for the $48 billion company. And if you look at how they did in this quarter, there was a ton to like. 48% growth on the top line, beat Wall Street's estimates, and their product revenue beat their own estimates by $20 million. Earnings per share also grew from break even last year and beat Wall Street's estimates. A lot to like so far. Let's look at margins. Non-GAAP product margins, those are the ones that I care about the most, were up to 77%. That's huge. It means that the company probably does have a moat here. Operating margins on a non-GAAP basis and net margins both expanded meaningfully and profitably. Free cash flow grew over 60% to $283 million, and non-GAAP, not including stock-based compensation, net income was $55 million. The balance sheet is in pristine shape. Now, speaking about how the company did, management had this to say. They are operating in an unsettled demand environment, and that was reflected in consumption patterns across the board. Remember, this company is paid based on the consumption of data queries that their customers have. And so if they start using these data queries less, then Snowflake will recognize less revenue. So that's really what was going on during the quarter, at least at the end of the quarter. However, they said that enthusiasm remained high, but enterprises, they are thinking about their own costs, and that is leading to some things. The CEO, Gary Slootman, said that he believes this may continue in the near term, but cycles like this do eventually run their course. Specifically, the chief financial officer said they benefited from strong data consumption in February and March. However, starting in April, the consumption slowed after the Easter holidays through today, and that's important. They did say that the strength was driven by healthcare and manufacturing customers who are using Snowflake's tools, and financial services, which has been a drag. They actually outperformed expectations. They said every customers were in line globally. However, their small and medium-sized businesses, as well as their Asia Pacific and Japan segments, were lower than expected. They also added a few of their largest customers were cutting costs in face of these headwinds. So that's some important color. That's one of the first reasons that the stock is down today. We'll get to that in a minute. They also said from a booking standpoint, because remember, they collect the revenue first, recognize it later, they saw headwinds globally, with the exception of large North American companies. Not due to competitive pressures, as we saw, because those gross margins were up, but because customers are just hesitant to sign large multi-year deals. Now, let's turn to the financial results. It is worth noting that stock-based compensation was up significantly. It ate up 41% of revenue last year's first quarter, 42% this year. Make no mistake, there is high stock-based compensation here. However, at the same time, because the company is so big and because it bought back some of its own shares, the dilution rate was 3.1% from the same time last year. That's high. In my opinion, not unreasonably high, but that's open for interpretation. If we look at total customers on the platform, that was up 29%. That is strong growth. If we look at customers with over $1 million, that was up 80%. They added 43 such customers during the quarter. That was one of the most important things I thought there would be to watch, and that is a very positive result. This is really important. The company benefits from high switching costs, but I've harped on this a lot lately. They're also starting to benefit from the network effect, because if a company offers up its data for others to use, they can do that. However, they have to be a Snowflake customer. And that creates a secondary moat in terms of network effects. And we see that playing out here. 25% of customers have a stable edge. That means the total number of customers that are offering some of their data on the marketplace is up 13% quarter over quarter. The total number of listings was 3%. And look at the number of registrants for Powered by Snowflake's data sharing was up 18%. That is really important because it means that that network effect is still getting stronger. Remaining performance obligations were up 31% during the quarter. That's somewhat weaker. That has to do with those bookings headwinds that management talked about. Dollar-based net revenue retention was 151%. You'd be hard-pressed to find companies with numbers this high. Again, that means they are not only holding on to their customers, but that those existing customers are spending 50% more than the same time last year. They're also benefiting from operating leverage. While the company is spending less on overhead, G&A, than they were all of last year, and about the same on sales and marketing, it is worth noting that the research and development costs, even after you back out stock-based compensation, was up. So they are investing in the future there. Importantly, their adjusted free cash flow, which I'm not a huge fan of, but their adjusted free cash flow, 46% of their revenue is translating into that. It's a bit lower if you throw out the adjusted part. But overall, here's the first reason the stock is down. Guidance was disappointing. Management's calling for 33% growth during the current quarter. Wall Street was hoping for 38% growth. And they said that there was slower than expected revenue growth at the company since Easter. And this is important. Contrary to last quarter, the majority of this underperformance was driven by older customers. So those older, presumably bigger customers are cutting back on their consumption of those data queries. And because of that, they're reining in their costs until they see a consistent change in consumption. And reining in that cost will be in the sales and marketing department primarily. For the full year, because of that, they also lowered guidance. That's the first reason the stock is down so much. 34% revenue growth for the year. Wall Street was hoping for 39% revenue growth. So what should we watch moving forward? First, that net revenue retention around 151. It can dip down. I hope it stays above 130. Second, the number of $1 million customers. It'd be good to see it over 400 by the end of this quarter. Third, the number of stable edge customers. That was over 2,000 at the end of this quarter, and I'd love to see it grow by at least 10% quarter over quarter. And fourth, free cash flow. Overall, in terms of the business here, the moat is most definitely widening. And to me, the thesis for owning this stock is very much on track because look, one of the primary reasons for the stock going down is because of the macro environment. And there's no evidence that Snowflake's moat is being encroached on. This macro environment will go in its ups and its downs. And if you're a long-term investor, then that shouldn't worry you too much. It's one of the reasons why this stock gets a 12, an anti-fragile, on my framework. However, the other piece of the reason the stock is down so much is valuation. Now, to think about valuation, we got to think about where this company is in its growth cycle. I would say it's somewhere between 3 and 4. Although it's not GAAP profitable, it's certainly producing lots of free cash flow. And because of that, we can look at things like price to gross profit, forward price to earnings, price to free cash flow. And for that, we go to YCharts. Thank you again to YCharts for sponsoring this video. You can start your free trial by clicking the show notes below and mention my partner Brian Feroldi's name, and you will get 20% off. So if we look at the company's forward price to earnings ratio, and that's a non-GAAP price to earnings, it is 252 times its forward earnings. This is an expensive stock. If we look at its gross profit, which has grown to about $1.5 billion over the last 12 months, it's trading for 32 times that figure. That is very expensive. If we factor in the company's free cash flow growth that they just reported, it is trading for 80 times free cash flow. Look, make no mistake, this is an expensive stock. Valuation is the second reason the stock is down. So it's valuation and the fact that the company cut back on their expectations. What if we look at a reverse discounted cash flow model? Will that give us an idea of how expensive this stock is? Well, we've actually created a tool. You can download this tool if you click on the show notes below, absolutely free, and you can run through it with any company. And basically, here's how it works. When you go to it, you type in the ticker symbol for the stock you're talking about. You put in their free cash flow over the trailing 12 months. Then you have to choose a terminal growth rate. I'll choose 3% because I think this is a fast grower. You choose how much you demand to get in returns. I'll say 10% per year over the next 10 years from Snowflake. And then you have to make these two numbers match, its current price and its estimated intrinsic value. For this, 5% is way too slow of growth for free cash flow. What about 25%? Well, that gets us pretty close. How about 26%? That gets us even closer. So that means that if I want a 10% return per year from Snowflake, they need to grow their free cash flow by 26% per year over the next 10 years. That is a tall order, although it did grow above 60% during this quarter. So how would I adjust it? It's a tall order. I would say I'd take off this many points, which would drop the score down to here. But make no mistake, I am a long-term investor personally. So while I can understand why the stock is down, I'm not bothered one bit because I believe that the company is becoming more anti-fragile over time. The stock might have to adjust, but the company seems to be in very good shape. I can see why others might shy away from it, but I have no intention of selling my shares anytime soon. We'll check back on this one in 90 days. Until then, Brian, out.